All right, everyone. So I want to introduce, and I'm very excited to bring him in for the webinar tonight. This is Chris Brown. He is the president of Tax Hive. Is that right?
President, CEO, they call me lots of different things. I don't know that it matters much though, but yeah, Kevin and I are partners, so it's
Chris is
great.
the man at Tax Hive. So we've been working with Tax Hive for well over a year now. With our clients, it's been phenomenal. Just the amount of tax savings our clients are seeing. Tax Hive is partnered with Kevin O'Leary. You guys probably recognize him, Mr. Wonderful. You see him on TV sometimes. And so Chris is going to be talking with us tonight about tax planning. And so we'll kind of go through a few points. We want to keep this very open-ended. So if you guys have questions, please do ask them. I always use this example when I was in 10th grade geometry. I had a math teacher that said, I'd rather have you feel dumb for 5 seconds while you ask a question than to actually be dumb forever because you didn't ask. So, put your questions in the chat. We do want to go through as much as we can with you tonight. We might have Gene Bott, Tax Hive's lead tax planner, coming on later as well. So that'll be maybe an opportunity for a live, FAQs kind of thing. But I want to go ahead and turn it over to Chris to kind of get things started tonight.
Well, thanks, Jerry, and thank you so much for letting us come on. It's amazing the partnerships that we get to have and the people that we get to work with. And you and your good wife are certainly at the top of the list. We just feel blessed to work with you. So thanks for having us. And we love your clients. Your clients are better educated than most, and that's a credit to what you do. I think your clients come over better educated, a little more sophisticated. And that's great for us. That means they're far more likely to go apply what it is that we do. I thought it might be good, Jerry, just to maybe give a little bit of background as to kind of how we partnered with Kevin, because I actually think it matters when you think about the approach that we take, and then maybe tee up the approach that we take. And then I know you have some questions you want to ask me about some strategies, and we can maybe jump into that. Does that maybe sound like a fair way to start?
Yeah, that sounds good. Let's do that.
So, we had my group had done business with Kevin in a previous business, and we'd done well. Things were good, and kind of as an ancillary piece of that business, we had a small tax group. And about 3 years ago, we realized how many investors, business owners were just significantly overpaying on their taxes. And so we went to Kevin with this idea that we wanted to do something to help fuel the economy, to help fuel investing, to help put people in a situation where they're better off financially, but in the process, they actually help out the economy. They help out their local area. They help build and grow in this country. And I remember I'm pitching Kevin. I'm the lucky one who gets to pitch him, and that was interesting. If you ever want to have some nerves, pitch Kevin O'Leary, and he just cut me off. Chris, I get it. And I thought I'd blown it. And he said, Chris, I'm in. I've done this before, and I love the business. But the commitments that he wanted from us, Kevin loves investors. And Kevin said that we had to do things like this, Jerry, with you, and have partners like you that believe in helping the small business owner, and that DNA of Kevin runs through our veins, that this is about helping the investors. And because of that, one of the things that we noticed along the way, and it has been a really interesting evolution really over the last 2 years, is that most people just simply dump everything on their tax accountant's lap, and they kind of throw their hands in the air, they bury their head in the sand, and they say, Jerry, do the best you can. Well, the problem is that type of approach to taxation is never going to save anybody any money. As great as our accountants might be, they can only do the best with the information that they're given. And the key to saving money on taxes is planning and doing right now things that are going to help you lower your tax bill next year. It's right now, it's January to December that impacts next year. Now, there are a few things we can do post the year to reduce tax liability. The bulk of things need to be done now to impact next year. So we kind of flipped the whole model on its head and we said, hey, we'll do taxes, but that's not where we service clients. We need to do a tax plan for every single client. We need to deliver a plan, put it in writing, show them what they can be doing right now to save money in taxes. And then when it comes tax time, we'll do their taxes and we'll take the strategies that they've used, we'll implement it on their tax return, and we'll get to work. But we've got to get ahead of the curve. We've got to give them information now so they know what to do now in order to help out come tax time. And it's interesting, we did an audit on all of our tax plans over the last 5 or 6 months. And I was actually shocked. I was shocked that on average, we were finding our clients over $40,000 in potential tax savings, not deductions, in potential dollars saved. Now, there's no doubt there's some people on the lower income range that's a smaller number, and there's clients making millions a year that's a much larger number than that. But when you think about 40,000 extra dollars, and Jerry, I know well what you do. I can't even imagine where somebody would be in 10 years if they had an extra $40,000 to put to work under your tutelage. I can't imagine where they would be. And that's so that's our philosophy. Our philosophy is certainly let's tax prep, and that's on everybody's mind right now. But let's look a little further ahead and let's make sure that we're planning so we can really capitalize on those savings.
Yeah, and I love that, Chris. The reason, and that was a big reason we partnered with you guys, is I've been in the financial industry for over a decade now, and I've worked with CPAs, I've worked with tax firms in the past, and we never found someone that really did a good, consistent job at, hey, let's do the planning first. And so it actually got to a point where I was like, shoot, if we can't find someone, I'm going to have to go start my own CPA firm. Like, there's just not a way. We've not found anyone that does it. So when we found you guys and started working with you, and we actually flew out to Utah and met first. It looks like we actually do have Gene here.
I was just going to tell you, Gene just texted me. He just jumped in.
Gene is the man, and this is going to be awesome. This was already going to be awesome with just Chris and I, but this is going to go to the next level.
You can say it's next level with Gene. I agree. This guy's brilliant. There's a reason I have him running our tax planning team, and you'll get a feel for it tonight as to why.
Awesome. So guys, I want to just take a real quick pause and just give a quick intro. So we have Gene Bott here. He's the lead tax planner for Tax Hive. Gene, if you want to give a quick intro on yourself, and we'll kind of continue on from there.
I have a confession. I'm the worst person at introing myself, but I'm Gene. I'm the CPA. I absolutely love working with taxes because I love being able to use the tax code to your advantage and help you save money. So that's what I like to do in a nutshell.
Awesome. So we're going to let Gene do that tonight. So guys, what I'd like to do is I'd like to invite you really quickly to do two things. As we're going through the webinar, post your questions for Gene in the comments. We'll go through those periodically and answer them. I do like to tend to go live with you. So if you've got a microphone, I'd be happy to mic up. You can ask your question live with Gene and we can get his answer. The other thing I want to invite everyone to do is one of my goals is to help you become a client of Tax Hive. So periodically I will kind of plug this throughout the webinar. If you're watching, this is our QR code. So if you want to just get this on your camera, on your phone really quick, you can also go to taxhive.wealthdynamics.com and you can schedule an appointment. You don't sign up right away. You're going to do a consultation with them first, find out what your needs are, if they can help you, and then they'll kind of go from there on getting you set up with them as a client. So I want to leave this up for a second, and then I want to just finish kind of explaining our partnership and relationship with Tax Hive. And really kind of the mindset that I have as an investor, as an entrepreneur, when I'm looking for tax savings. And we'll kind of go into some strategies with Gene and Chris tonight too. So, when we first partnered with them, we flew up to Utah, we met with Chris. It was something that we really looked at, will this be a good fit for us long-term, as partners and working with Tax Hive and working with clients. And so that really was what we saw. When you look at tax planning, right, that's proactive. Okay, and this is a very simple concept that gets overlooked is people just kind of generically say tax season. Chris and Gene, you probably hear this all the time. It's tax season, there's tax season. Yeah. Well, there's two tax seasons. There's tax filing season, right, which happens now. And then there's tax planning season, which happens now through the end of the year, as Chris said. And when you think about any kind of investment, like when you put money or capital towards something with the intention of getting a return, whether that return is through an increase in income or whether that's through a reduction in expense, and a tax savings would be a reduction in expense, right? If you look at any sort of investment, in my opinion, saving money on taxes is the very best investment. It's one of the first investments people should make. Okay, first things first, it's guaranteed. Like we know going into it how much we're going to save. There's no up and downs with the market, right? The second thing is the barrier to entry on it's very low. If I'm investing in real estate, I might need $100,000 or $150,000 in capital in order to get a 12% yield on my money, right? There's strategies with Gene and with Chris and with Tax Hive where if we were to put 10 grand into it, you might get the 10 grand back immediately. You might get 4 grand back immediately. And we're looking at that point from a first year, cash on cash return. As an investor, that's how I think. And I'm like, man, I just made 30-40% on my money that way, right? And so it's a little different of a mindset. And then the second thing that I love about it is that return is tax free. The money that you save on your taxes is not taxed as a return. So we're getting a tax-free yield. We're getting a very low barrier to entry. We're getting massive ROI on the back end. And it's something that is very low risk and it's consistent. And you have a team doing it. A lot of times, and Chris can attest to this working with real estate investors in the past, there's a lot of learning and management and time that goes into it. It's beautiful to have an investment that you can put money into consistently every year and someone else does the entire thing, right? You've got Tax Hive helping, you've got us helping, and we say, hey, here's all we need to do. We're going to take care of the heavy lifting. Here's the plan, here's the strategy. So that's kind of my approach with it. But what I would like to do is go ahead and open this up for some questions that we can maybe start with Gene. The first thing I would love to go over, Gene, is we've got some entrepreneurs that are working from home, right? The pandemic happened. A lot of people kind of migrated out of normal offices. How does someone qualify for the home office deduction? And what does that look like? How do they calculate that?
Yeah, so the home office deduction is a fantastic strategy. It's actually something that a lot of people are afraid of, and you don't need to be afraid of it. The IRS was hunting it in the past. There's no denying that. But if you could document it well, there was no reason to be afraid of it then, but they're also not hunting it anymore. So just don't be afraid of the home office deduction. There are two ways to claim it. There's the standard deduction where you're going to take $5 per square foot. That's not our preferred way because it's also going to be the one where you don't get very much. The other one is you want to be aware of the square footage of your office relative to the home. And then you just there's like a large list of expenses for your home that you just go through and you keep track of all these expenses and you allocate a portion relative to your square footage. Most people are going to be somewhere between 5 to 10% of their home is going to be a home office. And so you're going to be able to take about 5 to 10% of your square footage of your actual expenses on the home and deduct those. And you can get up into the thousands of dollars of range of tax savings relative to a home office, depending on how much you're spending there.
Yeah, can I just point out a couple things about that? I think number one, it's important to know that the maximum you can get on the standard deduction there is $1,500 per year. And so, like Gene said, typically, if we're going to actually do the work of measuring out the expenses, we're going to see a lot more money. For example, and not that this would happen every year, but if you replace your roof, you can't replace your roof over 92% of your home. You're going to replace it over the whole thing. And so if your home office is 8% of the home, you're going to be able to take a portion of all these different expenses. And to give you just a quick example, I was just going through things the other day, and we have Sarah, who's in a real estate business. And this one strategy alone, as she implemented it and worked it, saved her, created a tax deduction of $6,300. So the standard deduction is $1,500. She was able to get a $6,300 deduction. And you think about that, that's year over year over year. These kind of simple things add up significantly over time.
I love that. True. We just had a question come in. This is my client Avery. I want to bring Avery on real quick. Avery, I'm going to mic you up so you can ask your question live with us here. All right, so we're live with Avery. What's up, Avery?
Hey, what's up, Jerry? Hey, Chris. Hey, Gene. Thanks for hosting this afternoon.
Nice to meet you.
You as well.
Awesome. So what's your question? Yeah,
my question is, in terms of the home office expense, does that only apply if you're under a legal entity, or can it be applied if you work as a 1099 contractor as well?
It can be applied for a 1099 contractor as well. The great news is, as a 1099 contractor, you may not know it. You probably do, but if you don't, I'll tell you, you actually have a business. And so you can use the home office.
Can I,
Now, if you're,
oh, sorry, go ahead, Avery.
yeah, so I was just gonna add in, if you're a 1099, I would definitely look at, the benefits of setting up an LLC. And depending on your income level, this is a great segue into whether or not someone should do an S election.
You took the words out of my mouth. That's what I was going to say when we cross streams. Like, okay, we gotta take a second and talk S election here because this matters so much. So why don't we let Gene walk us through when we should be an S election, and maybe I can take why we want to be an S election too. But Gene, let's tackle this one.
Yeah. So the S corporate election, just so you know, this is not a guaranteed, if you're at this income level, you want to do it. But generally speaking, the vast majority of time, if you're at a point where you're making $30,000 or more in net profit, you really want to start considering that as corporate election. And that's $30,000 really after deductions like the Augusta rule and stuff like that. When you're before that $30,000 mark, chances are the cost of being an S corporation is offsetting the savings that you're getting. So it's around $30,000 that we really, but we can almost guarantee your savings from being an S corporate election are higher at that point in time than the cost that you're putting into it. But really, the $20,000 to $30,000 range, start exploring that.
So I think a couple things to be aware of with the S corp election. Let's maybe clarify this, and Gene, certainly jump in at any point because I know you and I do these a lot and we feed off of each other. But number one, the S election is an election of an LLC. It's not an actual new structure. It's an LLC that you choose to be taxed as an S corp. When you choose to take that election, you have to pay yourself what's called a reasonable salary. And so you have to compensate yourself with a reasonable compensation. So you've got to go on payroll. The key thing to understand about this, though, is you want your payroll to be as low as you can justify. And the reason is you're going to save 15% tax on the difference between what your payroll is and how much money you take out of the business and draws. That's where you save your money. You save your money in that window. So if you raise your payroll, there's a smaller window that you're going to save here. So you want to create a gap. Now, there's a great site. Gene always shares this. I'm going to steal this from him. A good rule of thumb, unless you're a professional, is usually around 30% of your net income would be a good starting point as payroll. But there's a great website I want you to take down. It's called rcreports.com. And this is a website that I know Gene sends so many of our clients to help them really dial in what reasonable compensation actually looks like. Because again, we want to keep that reasonable compensation as low as we can, put ourselves on payroll, because we're going to save that 15.2, 15.3%?
15.3, yep.
There you go.
Yeah, and we actually had a client recently with you guys that we sent over for this, because guys, what you're looking at is, if you don't do this, you're looking at federal income tax on all your profit. You're looking at state, right? You may or may not have local depending on where you live. So all of this, and then on top of that, you've got another 15.2% on your self-employment tax.
15.3.
15.3% on your self-employment tax.
Sorry.
So rather than having all of this come off of your profit, what we're saying is, if you do this election, you can send some of this over to your wage, right? With your W-2, the wage will get hit with all this, but then you can send some of this over as your distribution, and that distribution is only going to get hit with your state, federal, local. You're not going to have this on that entire amount. So it can be a pretty substantial savings, and it's something that's so easy and simple to do. A lot of people miss it, though.
It's incredible how many people miss it. It baffles our mind. I can't tell you how many people I've seen go back to their previous accountant and say, hey, do you think I should have been an S corp? And the accountant will say, oh, yeah, that would have been a good idea. But they're not planning. They're just preparing with whatever you give them, and they're not giving the direction. And it's amazing how many people are overpaying with that one simple rule.
That's incredible.
One thing really quickly, that RC reports will cost you a little bit of money. I think it's like $100 or so, but I've considered it well worth the cost if you're doing this.
Yeah, you're probably going to save more than $100 if you're in the position to do this.
Yes.
So on this note, we have a good question from Abraham. I want to bring Abraham on live really quick to ask his question. Hey, what's up, AJ?
All is well as far as I can tell. Thank you, Jerry, Gene, and Chris for having me. I just had a quick question about the taxes that you don't pay on distributions that you would pay on your salary. What's the difference between the 15.3% and like the Social Security and Medicare or Medicaid taxes? Like, what is the difference between those types of payroll taxes? Is that included in the 15.3? Is 15.3 definitely what you won't pay, but you will on the salary? I'm just trying to get a better sense of what's included.
Yeah, it's a great question. I love the question. The 15.3% and the Social Security and Medicare taxes are actually the exact same thing, except that when you're talking about a W-2 wage, that 15.3% is split between you and your employer. So you pay half of it and your employer pays the other half. So that was a great question. I love it.
Awesome, awesome. We got a few more questions here. So we've got one on some capital gains here. I want to bring Sabina on. She just sold some real estate, it looks like. So we've got a good question from her.
Hi.
We're live with Sabina. How are you tonight, Sabina?
Hey, Jerry. Oh my gosh. You're our favorite guy. I love you. And thanks, Chris and Jean, too. So I just sold my house this year, and I've invested most of it with Jerry's programs. I've got some Gold Club, I've got 150 in equity and help, and sacred account. And then I've just opened my premium sacred account. So moving right along here. But my question is, yeah, the capital gains, I understand it doesn't exist anymore. So can I use that 150 to offset it, or is there another tax shelter?
So when you're talking about the capital gains tax, first, is this your primary residence?
It was, but obviously no longer.
And in the last 5 years, how long was it your primary residence?
In the last 5 years, the entire 5 years.
Okay.
Well, listen up, because you're going to really like Gene's answer then.
Oh,
yeah,
good.
your total capital gains was 150,000. You said, correct?
No, I just took some of the money from the house sale and I'm funneling it all towards these programs, like, the gold sacred account with Jerry, and equity and help is a home investment program, a philanthropy investing program that I really like the idea of. But so I'm funneling some of the amount from the sale to these programs. But how do I'm about to submit the closing settlement with my CPA, and he's going to do his deductions and whatnot. But is there anything else I need to know before I submit this to him?
Well, the first thing you'll want to know is if you take the sales price and subtract out your original purchase price and anything else that increase your basis, but usually it's pretty close to that. That's going to tell you what the capital gains portion is. And are you married?
No.
Okay, then $250,000 of that is not taxable. Anything above the $250,000, that's where we need to worry.
Okay.
So
this is where deductions come in, like what I've paid the realtors, and I don't know what other deductions he's going to apply, but.
So how much did you sell the house for?
Oh gosh, is Jennifer on the line? No, is Jennifer here? It's 810.
810. And how much did you buy it for?
About 150, but I did refi it at some point. I don't know what my equity ended up being. I paid off about 200 to the mortgage, and so the balance from 810 is what, minus the realtor's expenses, is what I got.
So we really have you have roughly about $500,000, possibly $550,000 of capital gains. Okay. The first $250,000 of that is not taxable. So then we've got about $300,000 we need to worry about. You do have some options. We can look at some oil and gas strategies that'll help offset that. We could look at some qualified opportunity zones that would help offset that. We could, the qualified opportunity zone, we have about 180 days really from the end of the year to really get involved in one of those, and that would help. The oil and gas, you did this in 2022 or just barely?
You mean the sale?
Yeah.
Yeah, I just sold it on January 17th.
Okay, perfect. So we're going to have a long time on the Qualified Opportunity Zone Fund. And you do have until about the end of the year to look at the oil and gas strategies that you could possibly use for that as well. There's a strategy called an SOP that is very similar to the oil and gas, would be a great one. And so basically what we need is just options that are going to bring down your taxable income. You could look at charitable remainder trusts are really popular at this point in time. Just stuff like that. And I know Jerry can definitely help you with several of those options.
Yeah, I might have to
Yeah,
have
absolutely.
a one-on-one with Jerry there.
I think one thing I'll just point out here, you know, the beautiful thing is 250,000 of it, you're not going to have to pay taxes on. And that's the great news, right?
Mm-hmm.
And the other great news is because of what you're doing, there's all these different ways to save, but you have to be willing to invest. They don't just let you deduct things. But if you're willing to invest, which you are, and which Jerry's helping you do, so many of those investments can reduce that liability. And so the greater your willingness to reinvest, the more options somebody like Jerry's going to have to put you into to help you bring that tax liability down on the balance.
Yeah, and exactly. So what I would do is, I would set up a consultation with Tax Hive to go over some of the planning. So if you go to taxhive.wealthdynamics.com, and that's going to help you, just start to do some of the planning on the capital gains. The good news, like Gene said, you did sell it in January, so that gives us a lot of time this year. Typically with a sale, like we want to be planning as we go into it. So it's good that you're thinking with that. A lot of times I had a guy that sold a property, Gene. He got 900,000 in capital gains, and he contacted me 8 months after the sale, and I was like, dude. 2 months ago, we could have helped. Like this. So the sale thing, we really want to be on top of it. Okay,
Hey,
we have a question from.
Would you mind?
Liza.
Would you mind actually, Jerry? We just mentioned a whole bunch of strategies there that we threw
Yeah.
out. I would love to maybe, if you don't mind, give Gene a chance to maybe just break down one of them to just kind of demonstrate to everybody the power that sits inside of these strategies. So, Gene, I mean, we could hit conservation easements, we could hit oil and gas. But I think it'd be great for you to maybe just take one of those strategies and break it down for us a little bit. And so we can just kind of illustrate the power that some of these strategies have if implemented correctly.
Yeah, let's go with the conservation easement because I didn't hit that one, and that is definitely another option for you. So the conservation easement is actually one of my favorite strategies, category of strategies, not it itself. The conservation easement is a category of strategies that actually allows you to take and give money to a charity in a way that accelerates the impact of the donation that you're giving. So the traditional one is a conservation easement where you actually buy land, have a study done on the actual value of the land, and then donate it at its fair market value, which often will give you a 6-to-1 exchange rate, where for every dollar you put in, you're getting a $6 tax write-off, which is pretty powerful. I'm not as fond of that strategy per se because it is one that is considered one of the dirty dozen, meaning the IRS hunts it because of how much it's been abused. But some similar strategies to it involve real estate loans, mineral deposits, art grants and stuff like that, where you can actually go and buy at bulk pricing or at cost these various products, and then through some various means donate them at their fair market value as well, and get somewhere between a $4 to $6 tax write-off for every dollar you're putting in. Is what they're currently operating at, is somewhere in that range. And so it's pretty awesome what a conservation easement can do for you.
So I want to just make sure nobody missed that, because you can kind of easily skim over the numbers. So Gene, when you say 6-to-1 ratio, that means if I donate $1, how many dollars am I writing off on my taxes?
$6 write-off. Now I do have to say most of these have a minimum buy-in point. So let's talk in the neighborhood of $20,000 if that's okay. You put $20,000 in, you're going to get somewhere between $80,000 to $120,000 tax write-off.
So if I donate 20, I'll be able to write off 80 to 100.
Yep. And typically what we see is that gives you somewhere between a $1.25 to a $2 tax savings. So on $20,000, I'd expect you to have somewhere between a $25,000 to $40,000 actual tax savings.
Great. So guys, in investing terms, this means that if I put in 20 and I'm making 1.25 to $2 on my donation, like on actual tax savings, I'm making anywhere from a 25 to 100% return on my money with that investment through those tax savings. So, and this is just one of the strategies that Gene mentioned. And I'm glad that we dove into this because it really is like, when you think about it, like it's kind of a mystery, the tax code and how do people reduce taxes. Well, Gene just told you how to donate $1 and write off 6, right? That's in the code, that's available for all of us, but it comes down to, do we have an understanding of what the code says? My understanding is over 6,000 pages long of just code. Is that right, Gene?
Yeah, it's actually over 7,000 pages of tax code with we're almost over 100,000 pages now of content that actually defines what that code means.
So over 100,000 pages. So unless you have time to read that, that's where you hire a professional team. And with like, you know, and I'll talk with clients sometimes, guys, and I'll hear, you know, we have a CPA or we're working with an EA. And that's great, but you know, most of the time, the CPA, it's kind of like when you go to Starbucks during rush hour in the morning, they're just trying to spell your name right. Like they're just trying to get through the tax returns. There's no thought or planning that goes into it. So to really take the time to look at, okay, what does the tax code say? And what is that? How does that relate to your tax return, and what can be used and where can it be used? Then having a team that actually knows how to do that compliantly, because it's, again, I can cut my own hair. It doesn't mean it's going to look good. Right? I can do my own taxes. It doesn't mean that it's going to stand up against an audit. And then I've got a team to help implement it as well. So that's really the value. So really quickly, again, guys, I want to just bring back up, if you've not done this yet, grab your phone, pull the QR code up on your camera, or you can go to taxhive.wealthdynamics.com and schedule that free consultation with Tax Hive and their team. We're going to cover as much as we can. We got maybe 20, 30 minutes left tonight. We've got some more questions that came through on the chat. But again, 100,000 pages, there's only so much we're going to hit tonight. And I want to make sure you have the opportunity to speak with someone personally regarding your specific situation. So use the QR code or go to taxhive.wealthdynamics.com.
And Jerry, hey, can I make maybe one more thing? Just make mention of one thing while you show that.
Totally.
You know, one of the things that I find, we've been doing this a lot, and we hear some of the same stuff that you just shared, right? I have a CPA, I have an accountant. And what we do with a lot of people is we say, okay, you've got an accountant, but you aren't planning. Let's just start with the plan. And you'll experience our team. And certainly you can take our plan and go implement it with somebody else if you want, if they know how to do it. But let's at least get a plan in your hand so that you know what you can be doing now to save money. And what happens so often is after they get the plan, they go, well, hey, we want to use you guys for taxes too, which is great. But this stems back to an experience that I had when I was a lot younger. Had a buddy that said, Chris, you should be contributing nearly $50,000 into a qualified retirement plan. I told him he was crazy. I said, I'm maxing out my plan, but the government doesn't allow you to contribute that much, Clint. You're wrong. And Clint said, no, Chris, there's this tool called the solo 401k. And I argued with him. On my drive home that night, I called my accountant. I said, hey, my buddy said I should be doing this. What do you think? And my accountant said, Chris, for sure, that's a great idea. And I was so furious because I've been doing taxes with this guy for 10 plus years, and he'd never brought up the strategy to me. The minute I brought it up, he knew that I should. But again, to your point, Jerry, they get in the vein of just moving you down the line and completing your taxes and without using any critical thinking. And so oftentimes we'll just do the critical thinking, put a tax plan in place, and people can certainly use that with their CPA or EA, whoever it is they're using, if they so choose.
Yeah, that's a great example. We have a quick question from Lisa to go back to the capital gains exclusion on the real estate sale. So I want to bring her on so she can ask her question since it pertains to that.
Hi, everyone.
All right,
Can you hear me?
Lisa, how are you tonight, Lisa?
I'm good, thank you. Can you hear me?
Yes.
We can, yeah.
Why is $250,000 not taxable with the capital gain?
That's an excellent question. There's a section in the tax code that defines a homeowner's exclusion, which means if this is your primary residence, you are allowed to exclude up to $250,000 per taxpayer. And I say per taxpayer because if you have a spouse, it's $250,000 for you and $250,000 for your spouse, for a total of $500,000.
And I think the rule, Gene, just to
Thank
make sure we tell everybody correct here, we've got to have lived in the house. Is it 3 out of the last 5 years, I believe is the number?
Yes.
Perfect. Okay, good question there. All right, we've got a bunch more that just came in. So we have someone that asks, can we discuss a little bit about charitable remainder trusts? Gene, do you up for this one?
Discussing a charitable remainder trust. I love discussing a
Yeah, kind of
charitable
just high
remainder
level,
trust.
how it works, what it does.
Let me first hit Chris's statement again. Sorry, Chris, I misheard you. You said 3 out of the last 5 years. It's actually 2. I'm sorry.
Right.
Okay, so charitable remainder trust. So charitable remainder trust falls in the category we call donor advised funds. There's actually a donor advised fund category that it takes its, or excuse me, trust that it takes its name from, but it is one of the donor advised funds, and there's multiple of those out there. So there's charitable lead trust, charitable remainder trust, charitable annuity trust. It's like there's a lot, and they're pretty awesome. Sorry, that should be CRAT. I apologize. Charitable remainder annuity trust. Okay, so the whole goal when you're doing one of these strategies is to actually get 3 different benefits out of it. 4 really technically. First, you're putting money into a trust for the purpose of donating that money to a charity either during the life of the trust or at the end of the trust. It's usually about 20 years that the trust is going to last. And you're going to get a tax write-off for the donation you put in. With a charitable remainder trust, it's at the present value of the future contribution, and it's going to go to that charity at the end of the trust. So that's the first thing, is you want that tax benefit of the donation that's going to go to the charity. The second benefit is you are giving money to the charity that is usually the equivalent of the principal portion that you put in there. So the money you put in, it is going to go to the charity, and that's going to be your second goal. Third thing you're wanting out of that is a growth component that is going to pay back to you. And just so you know, there's different with all the different ways this works. Some of these nuances are different, but this is all for the charitable remainder trust. You've got this growth component that's going to pay back to you. Typically, we've seen these pay out on average about 8% per year, which over 20 years, you're usually going to get back a little more than 100% of what you put into it. And then the fourth component is you actually usually use a portion of that growth that's coming back to you to actually buy a life insurance policy of some kind. I personally like IULs and VULs and stuff like that, index universal life policies. And that's going to define a portion as going to your beneficiaries at the end of it. And over 20 years, it usually doesn't pay for the entirety of the life insurance policy, but it usually pays for a large chunk of it. And so at the end of the 20-year time period, you have those 3 benefits where you've taken your money and really created 2.5 to 3.5 times the value of the money is what it started out as. And you also got a tax write-off while you're at it.
Use it over 20 years, 2.5 to 3.5 times what you put in.
Yep. Coupled with a tax write-off.
Awesome. And guys, these are pretty complex. So when you're doing like a charitable remainder trust, charitable lead trust, there's going to be a couple of key players. So the first one is going to be Tax Hive, right? You want to get with Gene and you want to get with Tax Hive and you want to say, hey, this is the strategy. The second side is going to be a law team, right? So you want to have a legal firm that's actually designing your trust documents. We have a webinar next week with Hive Law. So they are affiliated with Tax Hive. We kind of work hand in hand with them, with our clients there. We do some back and forth. So it's great to have that synchronization where we have the law side handled, we then have the tax side handled, and then my firm can then help with the life insurance and the investments too. And so we kind of got all 3 of those boxes checked. Gene, who would you say this is best for? Like what kind of financial situation, net worth, tax burden are we usually looking at with a strategy like this?
So with the donor advised funds, there's a few different key points. Like there's a strategy out there called a family endowment plan that is also very similar to this. That really is, if you're in the $1 million range where you can afford to put $1 million of assets in it or more, this is almost guaranteed to be one of your most favorite strategies in the entire world. You're going to love it. But you do need to be able to put $1 million worth of assets with $100,000 or more, basically about 10% of it as cash. But if you're not at that point, you can actually get involved in a charitable remainder trust with just a few $1,000s. I personally like it when you're $20,000 or better. When you're down in that range, usually it's because you have some sort of event where you're creating, you've got an inflow of money that you weren't expecting, like an inheritance, or you sold a property and have some cash that you can afford to put in there, something along those lines. So more often than not, the charitable remainder trust is usually targeted when you have a sale of an asset that you inherited. Having said that, it's still a fantastic tool. If you're charitable minded anyway, it's still a fantastic tool to offset any source of income you've got, including your W-2 income. There's a question in here about what's something you can do if you just have W-2 and you don't have a business. Well, this is one of them.
That's awesome. So this is something like, could somebody do this with their church? Like if they wanted to donate to their church and the church is a charity, this could be done?
So long as it meets the qualifications of a 501c3, yes, this can be used that way.
That's awesome. So a good example of one of the things Gene just kind of said, and I want to make sure you don't brush over this, is let's say that I sold a rental property. It was not a primary residence. I do not have the exclusion that Gene mentioned, and I sell it with that cap gain. If I have a strategy set up like this ahead of time, Gene, what you're saying is I could actually gift the property to the trust first, sell it within the trust, avoid the cap gain there, and then I have the funds, plus I get a deduction on the donation.
You could do that, yes. It is a possibility.
Awesome. Yeah. So, and again, there's a lot of nuance that goes into this. So this is going to be all circumstantial. What is your circumstance? What's going on in your universe? And then having Gene's team really take a look at it and coming up with a custom strategy.
Can I make one comment though, as we bring up that putting real estate into a charitable remainder trust? I have had a couple clients in the past that they just have real estate that they plan to own long-term, and they have done that where they put it into a charitable remainder trust so that it's defined as going to the charity at the end of the term, and they're getting the benefit, but they're also getting all the growth over the 20 years of that property being in there. And those who intended to give away that property anyway, that worked really well for, or if they were planning to sell it, that worked really well for. But don't use that strategy if you're not planning to give away that value at the end of it. I've had somebody do that and they were not happy. So please make sure it fits.
That's a good point. It is charitable, right? So you want to have that in mind. And I think that a good offset there is if someone wants to do the donation, but they don't want to lose the legacy play, that's really where that life insurance policy comes in, because then you can give away the asset. The policy makes sure that your kids, your grandkids, et cetera, still have funds tax-free. And then you kind of get the best of both worlds.
Yes.
So Gene, this is one we just got in from Avery again. So he just wants to know where could he maybe find a list of expense categories to keep track of relating to a home office expense? Like what should he be thinking with as far as what things he could write off if he has a home office?
Yeah, great question, Avery. If you get a tax plan from us, we're actually going to give you a list that'll outline that for you. But some things, it's really just that there's like 20 different items. You can do repairs on your home, maintenance on your home, upgrades to your home, utilities in the home, internet costs of the home, supplies that you purchase for the home, any phone bills that are through the home, stuff like that. There's like a list of 20 different items that can go into there. Lawn care is one of my favorite ones, lawn care and pest control, just because you don't usually think of those. So I love those.
Perfect. And then this is a good one we just had coming from Justin Foster. And I have this one come up quite a bit. I want to bring Justin in if he's still on. He may have logged off. Okay, so this was one we actually sent over to Chris. So Gene, we hear a lot on the tax code. If you're a business owner, if you're an entrepreneur, there's all this stuff. And for the W-2 guy, it's kind of like, that sucks. Like, what do I get to do, right? So what are some of the things if someone is a W-2 earner that they can do, like as far as strategies and ideas?
Yeah, great question. I love this question, Justin. I hope you're still here to hear the answer. The first thing I would like to point out before we dig into those strategies is the tax code is really written to benefit investors and business owners and self-employed individuals. So keep that in mind. What you're going to want to do in order to take advantage of this to offset your W-2 income is really something along the lines of getting involved in one of those three categories: investing, owning a business, or being self-employed, something along those lines. So investment is one of the best ones for you as a W-2 earner, where you get into some investments along oil and gas strategies. Qualified opportunity zones are a fantastic one. Basically starting a business and taking some Schedule C losses for the first couple of years. Just be aware, if you're going to do that one, you have to be aware of the hobby loss rules and be very careful with it. but it's definitely an option. These charitable contributions are a fantastic option through either the donor advised funds or the conservation easements. I will tell you on the conservation easements, it's usually a popular strategy for you when you're up at around $250,000 or plus in income that you're getting in. In lower amounts, you can still use it. It's still a fantastic strategy, but usually you're buying future savings rather than current savings. So I hope that covers what you're looking for.
I might just throw a couple more out there, Gene. I think for a lot of people, an HSA is a great play. Especially a guy like me, I've got 4 daughters, right? And it seems like somebody's always got something going on. So a health savings account, I'm sure most of you have heard of it, but it's amazing how many people don't use it. If you don't have, Gene talked about some of the more advanced strategies for higher income earners, but just some qualified retirement plans are a great place to start. If you aren't setting money aside into an IRA or something along those lines, that's a great place to put some tax deferred dollars that are going to grow for you over time.
Yeah, and on that note, actually, some of you guys that are listening are clients of mine, and we're really big on having control on investments. So the downside of the 401k and stuff has always been, hey, the money ends up with Wall Street, and I don't really know what's happening. Some people are okay with that, some people aren't. We found a registered investment advisor that does something called a self-directed brokerage window, which means if you have a 401k at work, there is actually an opportunity where you can still put money there, you can still get the tax deduction, but you're not sending it over to Wall Street. You can actually still put that towards real estate or private lending or gold or silver. So, that really does open things up quite a bit, where somebody is not putting that money away to just hope that it's there when they're 60 and Wall Street does a good job with it. Track record of Wall Street doing a good job has not been great. If you watch most of the movies, they're not good stories of what happens on Wall Street with money. So I just want to make that note there, because that is a consideration, and that's actually something we'll now be able to help with. Is let's do those deductions, and also we can still have a lot of control over where that money ends up going. Okay, good. So the other thing I wanted to cover, Gene, was we've got a couple questions on writing off health insurance. And I recently just had a client do this. I know Chris just mentioned the HSA. So I think this is a good segue into, can a business write off health insurance? What does that look like? And then what is the benefit of doing that plus having an HSA?
Yeah, I love that question. That's a great question. So yes, a business can write off health insurance. And the way that you're going to go about it really kind of depends on the kind of business. So if it's a sole proprietorship, for example, sole proprietorship is going to have it easy. All you need to do is keep track of your expenses, and we're going to take a self-employed health insurance deduction on your tax return. But you want to turn those in. Now, you want to be making sure that you're working with an accountant that knows what they are doing, because I have seen business owners have their health insurance costs claim on the Schedule A under itemized deductions, which is always an option, but it's not the best option for you. You want it on your Schedule 1, where you can actually take it dollar for dollar and you don't have to meet certain income limits and stuff like that. So make sure you're working with a tax professional that gets it done right. If you're in an S corporation, we have to get that on your W-2 for you to be able to claim it, but it is still, it's really funny. It's a stupid way that the IRS works, but you put it on the W-2 so that they can charge you the withholding tax on it. It's not subject to the payroll tax, but you pay the withholding tax, and then you get it back when you file your tax return. So it's stupid. You end up paying nothing on the tax, but you do have to go through that. You pay and get it back. But that is required if you're in an S corporation. So make sure it's going on to your W-2 if you're an S corporation. But it is one of those you get 100% of the write-off. Now, some of the expenses to keep in mind that you get to put in there include your premiums on your health insurance if it's not covered through some sort of employer account, any out-of-pocket expenses for co-pays or prescription drugs or medical equipment or stuff like that. So if you have a doctor's note that you have to have a swimming pool, you can actually write off a swimming pool. It's pretty awesome. Probably not going to happen, but it's good to know, right? Anyway, stuff like that.
Depends on the doctor, I guess.
That's right. Just get into the equine therapy business and build a pool for that. It's going to be great. But no, so then the HSA, you brought up the HSA. That is one of the best tax strategies out there because it goes in tax-free and it comes out tax-free if you use it on health insurance. And most of us at some point in time are going to have health insurance, or excuse me, health costs. Most of us will have health costs at some point in time in our life, and you are building a bank account where you don't ever have to pay the tax on it. And so it's a fantastic strategy.
You could use that for deductible, chiropractor, dental. I mean, there's a lot of stuff that your insurance might not cover, or maybe you've got to pitch in before insurance will cover it. The HSA is there. What Gene's saying is you're going to pay it anyways. Why not get a tax deduction on the front end and then tax free on the back end?
Yeah.
And then the other thing that most people don't know about the HSA is you actually can self-direct that. So if you don't use it for health insurance related expenses or health related costs, you can self-direct it and let it just sit there and grow tax deferred. And that's where you could put it into real estate. You could do private lending. You could do gold. You could do silver. Gene, does it convert similar to a traditional IRA at 65? Is that right?
When you say convert, what do you mean by convert?
So you can take money out of it similar to like a retirement plan. I think it's at age 65 with an HSA.
So the only caveat is if you want it to be going in tax-free and coming out tax-free, you need to spend it on medical expenses. You don't want to just take distributions from it. So yes, you can, but then you'll end up paying taxes on it.
Right. So you could
But
pull
the
it out
money's
as very
been
similar
growing.
to traditional IRA.
Yeah. One other thing to be aware of, well, two other things to be aware of with the HSA, you do have to have a high deductible health plan, which basically means you're going to have a deduction or a deductible that's like greater than $2,500. You probably are on a high deductible health plan and can use the HSA. If you can't and you do have an employer, you're not the business owner, you can possibly talk your employer into getting an HRA set up, which does actually allow higher contribution limits into it. You can go up to like $25,000 instead of the $7,000. So it allows for more, and it doesn't require a high deductible health plan, but it does require that you're an employee. So there's that.
Awesome. We just had a question about the checkbook IRA or the self-directed IRA. So Gene, if you want to hit just maybe the tax side of contributing to an IRA, and then I can talk more about the checkbook or the self-directed side.
Yeah, so the IRA is a fantastic strategy that allows you to save money. And we have this Secure Act 2.0 that would recently pass in December that is really great in that it made it so that you can actually do Roth contributions in any type of retirement account, employer and employee portion. So it's enhanced the ability of all of those. But the IRA, the reason I bring that up is when you're talking about doing an IRA, you do need to be aware, first and foremost, that if you are doing a traditional account, you're trading future savings for current savings. And if you're going to hold that account 5 years or longer, the Roth IRA account is probably going to save you 2 to 3 times the amount that you would save in the traditional account. So you really want to be aware of what the future potential is and why maybe you don't want to be using the traditional account. But if you are really looking for current savings, the IRA is a fantastic way to do that, or some sort of account like the cash balance account that even allows a whole lot of money into it, or some of the accounts that I know Jerry's talking about with you all the time. These are fantastic options. Does that cover what you're looking for, Jerry?
Yeah, for sure. And with the IRA, it's important to note too, there are income limits on that. So at certain points, you're going to phase out or not be able to contribute as well.
Yes.
So, and then on the checkbook side, what this question is asking is with an IRA that really is just part of the tax code, similar to the 401k. So we have this idea because of marketing that it's like this thing, like it's like an object. Well, it's really just kind of more of a law, right? And so you have to set up a document, usually with a trustee, that says, hey, this is the provisions of the IRA. It meets what the tax code requires. Typically, we're going to have a custodian who holds your assets. We have a record keeper, and that really is kind of the extent of it. Wall Street and the banking industry plugged into it and really put a lot of marketing behind it to say, hey, and also we're going to sponsor them and you can only choose from our funds. So a self-directed IRA or a checkbook IRA is a custodian that's passive. They say, hey, we are not going to limit you. You can put this in real estate. You can put this in gold. You could buy a farm with it. You can, as long as you're not self-dealing, putting it in your own business, giving it to your relatives, that kind of stuff, then you have a lot of flexibility. So my company, we specialize in self-directed IRAs, and that's kind of one of the 1-2 areas where G might say, hey, set up an IRA. Instead of going down to the mutual fund shop, come see us. We'll do a self-directed one, and you can put money to work and have a lot of control over it.
Yeah, and you want to make sure, if you don't mind me interjecting, Jerry, I'm sorry.
Yeah, go ahead.
you do want to make sure when you're doing a self-directed IRA, you work with a specialist who knows exactly what they're doing, because they're easy to break the rules on those. And Jerry knows how to not break those rules. And if you break those rules, it's significant tax consequences. So make sure you're working with somebody like Jerry that knows what they're doing.
Yeah, exactly. Don't do your own dental surgery either. That's
Yeah.
kind of the moral of the story there. So what I would like to do, we've got a couple of minutes left before we wrap up here. I want to pull back up the QR code link, but if we could do just a quick kind of lightning round, maybe all three of us, we could just each share our favorite personal tax strategy. And I know there's a lot to choose from, but Gene, if you want to lead off on, if you had to pick one that most people don't know about, is kind of your favorite one, what would you pick?
Oh man, that's rough. It changes day by day, but I think right now it's probably that family endowment plan. I know it does take a lot of money to get into it, but if you've ever heard of the Rockefeller Trust, it's a very similar idea where you're building a family bank, but it's really kind of a legacy account that's going to be incredible for you.
I love that. We talk about that a lot with the Rockefeller plan. Chris, what would you say is your personal favorite?
You know, I shared this one because it's one that so many people haven't heard of. It's called Rule 280A, or the Augusta Rule. In short, what this allows me to do is it allows me to rent out my house up to 14 days a year and not pay taxes on that. So I could rent it out on VRBO for 14 days a year, but that's not where I'm going to get the biggest bang for my buck. If I own a business, I could, for example, hold board meetings at my home. I could hold those 12 days, 14 days a year. My business could pay me for the rental of my house. My business gets the deduction. I don't pay taxes on it. There's a great website called peerspace.com, P-E-E-R, peerspace.com. If you look up boardrooms there, you're going to be able to get documentation to be able to charge yourself. Gene and his team recommend about $1,600 per day. So, you know, this isn't $200 for a VRBO. This is for a boardroom, $1,600 a day. You do that 12, 13, 14 days. That is a huge, huge, huge tax savings.
I love that. I would say one of my favorite ones actually has to do with that capital gains exclusion we meant to mention on the real estate. A lot of people are going to buy a house, and if you're gonna move and sell it, you know, one of the strategies that I think is really cool is if you set up an S corporation, you can sell the primary residence to the S corporation, get the capital gains exclusion, put that on a land contract, and sell or finance it to the S corp, and then you can turn it into a rental, and essentially you can get pretty much tax-free income because you've got the deduction on the mortgage with the interest expense, you've got the exclusion on the capital gains, and then you also have the depreciation now for the S corp. So that's a great one if you want to keep all of your real estate long-term and turn that into rental income over long periods of time. Really quickly, I do want to just point people back to, if you're watching this and you're interested in learning more about Tax Hive, getting a strategy, working with the team, this is the information to do that. So the QR code, you can pull up the camera on your phone, just point it at the screen. That will take you to the link. You can also do it the old school way if you go to taxhive.wealthdynamics.com. That'll take you right there as well. And really, I want to just, as we wrap things up, kind of explain the relationship and how this should look if you're looking at moving forward with us, right? So the first thing is to schedule that call with Tax Hive, get signed up as a client. One of the very first things that's going to happen is you're going to start, the planning process, right? And so that planning process is going to be going through, and Chris, maybe you can quickly dive into, you guys use an artificial intelligence software that does a lot of cool stuff on the planning, right?
Yeah, it's pretty amazing. We sunk a bunch of money, candidly, into some software that goes out, as Gene mentioned, the tax code is so broad. So basically what we do is we have every client give us, number one, their last year's tax return, and number two, answer a questionnaire that's it's a smart questionnaire that then goes through into our software and starts combing through to help us understand where to look. Then you need an actual tax expert. So someone like Gene, a member of his team, gets into the software and using the software, looking at thousands of potential deductions, puts together, typically it's a 30 to 80 page plan that's going to include what the deduction is, how much money it's going to save, but most importantly, it's going to include step-by-step directions on how to implement it. And then perhaps the best part of the whole thing is Gene and I do trainings every Tuesday, Wednesday, Thursday for the clients that have plans to come just in a forum like this and ask as many questions as they want about implementation of those strategies to ensure that we're saving money.
And And the cherry on top, guys, is you can then come back to my company with that plan and say, hey, here's what Tax Hive gave me. And that's our marching orders. If we're going to set up a cash balance plan, or we're going to do an IRA, or we're going to do, a charitable remainder trust, we can then actually go through and implement all that. And then on top of that, then there's the filing component, which, I don't want to brush off. That is something that gets handled, but it kind of takes the attention off of let's file a tax return as fast as we can to then, hey, let's pause. Let's do a really good job at the planning, and we can file once we're ready. And that's the beauty of working with a team that really is proactive on the planning side. So again, if you use the QR code, that'll take you right to the page to get started for a free appointment, a free consultation. You can go to taxhive.wealthdynamics.com as well. And we will be having Gene and Chris back probably in the next few months here to do more. So if you have more questions, let us know. Anything you guys want to close out with before we wrap up tonight, guys?
No, I'm feeling satisfied.
I
love the questions.
I just say thanks so much, Jerry, for the time, and genuinely to all of you, go schedule that appointment. Let us spend some time with you for free to see what we can or can't do. If we can't help you, we'll certainly be honest with you and point you other directions, but it'll be worth 15 minutes of your time, I promise. So go schedule that appointment. A member of our team will get on the phone, see what we can do to help you out. And who knows, before you know it, you might be on the phone having Gene go through your business, through your investments, telling you how to save money. So we'd love to work with you.
Awesome, guys. So thank you all for tuning in tonight. Again, next Wednesday, same time, we're going to have Hive Law on to talk about asset protection and estate planning. So we'll send out the registration link for that again. One last time, because I want to make sure we don't miss this. If you did not go to the link yet, here's the QR code again, or you can go to taxhive.wealthdynamics.com. So I look forward to seeing as many people as we can schedule. We want to save a bunch of taxes this year and then do smart things with that money in turn. So thank you all. Have a terrific Wednesday night, and we'll talk to you all next time.
If you're wondering, what does Wealth Dynamics do? How can we actually help you? Number one, if you haven't gotten a copy of my book, Blueprint to Financial Freedom, grab one now. You can get that down in the comments in the video. You can get the link for that.